Hi, this is Tori Agler with McIlvaney Precious Metals, and I'm going to run through a little bit of a recap of the second quarter, as I've been doing on not only a monthly basis, but certainly on a quarterly basis. And we have found that it helps a lot to get a little visual to go along with what we're talking about. So I want you to see here, just in terms of this healthy metals market that we've experienced in the second quarter of 2024, certainly a continuation of the first quarter as well. I'm going to get into some charts and technical analysis, but I also want to touch base on some of the underlying fundamentals and then finally close with some recommendations for you. So getting into the technical analysis, gold had a strong second quarter again, up 4% just in the quarter. We saw a high just below 2,300. I'm sorry, a high just above 2,400, around 2,450, and a low just below 2,300. So a little bit of volatility in there, as you can see by this sawtooth type of activity, but all in all, gold's up 12.7% in 2024. We would take that every year. Unfortunately, that's married to some negative news in other sectors. Silver is up 17% in the second quarter, so a very strong quarter by silver, playing a little bit of catch up because gold had the strong first quarter, and that gold to silver ratio had widened all the way above 92, which we'll talk about in a little bit. Silver's up 22.5% so far this year, as you'll see by this chart. And so that's a really fun price action, even though we have sort of stalled and gotten into somewhat of a declining pattern here. Platinum also had a great quarter, up 11.4%, and finally starting to reward some of you investors that have a minority position in platinum. But so far in the year, it's relatively flat. You'll see we started back here about where we finished, up half of a point. So not a whole lot to speak about, but hopefully this trend is able to continue and that platinum's come into life. Palladium continues a long, slow decline, down another 1.6% in the quarter. However, it is just a small part of the bigger picture, which is down 12% year to date. So we have avoided palladium over the last couple of years because of its run. We've been on the platinum side. We're still waiting for a platinum to palladium type of ratio where we're actually able to pick up some palladium at a real discount, having waited patiently in platinum. So another dynamic here and a good technical analysis to look at is this gold to silver ratio. So I mentioned earlier, we had topped out around 92 to 1. That's just if you take the gold price and divide by the silver price, we got 92. And that's when we had our silver buy signal. Silver was under $22 an ounce and the ratio hit 92. Since then, we've had that big silver rally that I just pointed out. Topping is high. I mean, we exceeded 30% at one point when we topped out at 32.50 for the quarter. So when we came down here to 72, we actually had nearly a ratio trade, depending on where you got in. Since then, it's rallied, and we're closing the quarter right in the middle of the channel, almost at 80 to 1. And this does reflect a good buy signal for silver when we get above 80 to 1. But we would love to see this decline come down further, and we'll be making some moves in some of your accounts. Here's the gold that I talked about, the gold chart breaking out to that high of 2,450. And you'll see the start of that breakout was in March, and that breakout continued after the first of the quarter. So April, May, and June, we had again a nice strong rally. But we've come down to these Fibonacci retracement levels. The reason I have this image in here is I know a lot of you are going to wonder where we might correct back down to. So anytime you have a high to, a run to new highs, you're going to have a little bit of a correction. And that's what we've seen so far. This is called the 382 Fibonacci. It's just under that $2,300 figure. So that's kind of an entry point number one for me. Entry point number two is really going to be right here at the 50% retracement, which is going to be around 2,250 or so. And then if we do get a little bit of a gift, I know it doesn't sound like it for those of you that already own gold, but we would love to see $2,200 gold, which is the 618 Fibonacci retracement level. And you'll see with where we've put in these lows now, 5 or 6 times, we've already come down and tested that just below 2,300. Gold turns around and reverses the other direction, and we'll see what happens. But that 2,200 level that I talked about, you'll see that's actually corresponding with the trajectory of the 200-day moving average, a long-term moving average of the price. Anytime you get this big overshoot, you can pretty much guarantee you're going to eventually come down and touch it. And that's kind of what we're seeing here, is that we're going to hopefully align around the $2,200 figure. Silver, likewise, topped out at $32.50. That happened in the quarter. That's the highest that we had in many years. However, it's put in higher or lower highs and lower lows since that period of time, and it keeps coming down and testing right around the $28.50 mark. I really feel like we could come down and see the 50% retracement here in a softer summer, which tends to be a seasonal trend for the metals. Maybe even that 618 where we come down right to around the 2630 mark, which was the start of this recent rally here that we saw back in May. So don't be surprised if we see that happen. And again, those are buying opportunities. It's not an interruption of the longer term bull market trend. Why do I say that? Because of the underlying fundamentals. The underlying fundamentals are what drive the prices. Gold and silver tend to react, call the fundamentals the news, right? So we're going to get into some of that. All of the fundamentals that push and pull on the precious metals prices can be either bullish or bearish. Bullish meaning the price should go higher. Bearish meaning the precious metals prices should come down. And here's a list of, I'm not going to get into every one of them right now, but you can pause this presentation and look at these bulls and bears and really kind of understand why is it doing what it's doing at any given point. One of them is the US dollar index. So what is the dollar index? It's a metric that really reflects the strength of the US dollar relative to a basket of other currencies. So there's 6 currencies in the dollar index: the Japanese yen, Swedish krona, the euro, Canadian dollar, the Swiss franc, and obviously the US dollar. So when this dollar index is up, it's a metric, and it tells you that the US dollar is doing well relative to those other currencies, those other major trading partners. Okay. What this chart shows you is gold overlaid with the dollar index. Now it kind of looks like a similar trend. They both have been climbing. Okay. But what you'll see is that when one is up, the other's down. And that's an inverse correlation. So here you have gold down, dollar index up. As the dollar index drops, gold climbs, right? So you see this opposite type of effect. And the reason that's important is here, as of late on the gold decline, we've seen the dollar rally, and we'll get into that here. So here's the US dollar index. This is just the month of June, and you'll see this little rally. Well, the month of June is also when we came off of the highs in gold and came back down, to touch the $2,300 level off of the 2450. So that's a good explanation as to one underlying fundamental as to why. And that dollar index, however, is climbing up. We crossed the 106, and we're getting into that 107 to 108 barrier that has served as a 2-year ceiling. So we do expect to see the US dollar index top. It's not like dollar policy is really strong. In fact, they're talking about cutting rates, which is weak dollar policy, and then you would end up seeing that dollar index decline and gold come back up. All right, so in terms of bonds, they're another underlying fundamental. So this is a chart of the 10-year yield. Okay, the 10-year yield's up 14.6% year to date. That should result in gold going down. In most other instances, it would reflect, downward pressure and be a major headwind for gold, but not this year. And the reason being is that there's uncertainty, global uncertainty, not only with the US government, but with the US dollar and certainly the global geopolitical scene. So what that means here with the bond yields is that despite the yields climbing, what that means is that there's not as much interest in buying our debt. And so that increases, obviously, the uncertainty in the markets. All right, so another underlying fundamental, certainly geopolitics. We are listening to the news, seeing the news. It's not just Russia and Ukraine. Now it's developing into a Russia-NATO type of tension. Israel and Hamas is appearing as if it's building to a little bit of a calm relative to what we had been experiencing. And that's kind of why we expect an Israeli Hezbollah or Israeli-Iranian type of conflict now to raise its head. So we're watching that. That would certainly drive gold higher globally, as would China and Taiwan, any increased threat there, as well as even a domestic terror threat. That now is certainly growing in its potential and something that we all have to have our eyes on. US politics is a good fundamental for gold. Yes, we have the November elections coming up. We actually have over 60 other elections around the world. So it's not just US, but US politics, it's not just the elections, it's the laws that are being passed that are creating uncertainty. They're creating a lack of trust in the institutions. That's creating instability and uncertainty, and that certainly drives the gold price higher. But that domestic instability, and I mean social, if you get social unrest, that obviously is going to drive gold higher. The de-dollarization, okay, so this is all to remind you why we're positioning in gold, but that dollar dominance is dwindling. We've seen BRICS start to ramp up in their push of not only forming an alliance with global trade, but also with developing their own currency, potentially a commodities backed, maybe even partially gold backed currency. You've got the talk of the central bank digital currency. So if our central bank does develop an outright central bank digital currency using the new technology, then that's something that obviously is going to lend to the lack of trust in the institution and concern with privacy and everything else. But also the petrodollar, probably the biggest news of the quarter relative to the US dollar is the 50-year agreement that we had with Saudi Arabia that all oil globally would be traded, through Saudi Arabia, actually through the US dollar, and they have decided not to renew that. So it was a very quiet event on the mainstream media side of things, but a very significant event nonetheless. And again, that just means that Saudi Arabia and OPEC can deal in oil outside of the US dollar in local currencies for other countries. Banking sector concerns, I really want to touch on this because this is a big one. The 20 largest banks laid off 66,000 employees last year. That trend is continuing this year. There have been over 400 branches closed in 2024. So there's only been a couple of bank failures, outright failures, but what we're seeing is mergers, we're seeing acquisitions, we're seeing banks saved or absorbed kind of preemptively rather than just being allowed to fail. So that's a big thing to keep an eye on. We're on pace actually to have 1,300 branch closures this year if that maintains its pace. Credit card debt surging to a record high, not good for banks if people start to default on those. Non-performing loans, which are loans that are more than 90 days delinquent, rose $6 billion year over year. That puts banks under a lot of stress because of the fractional reserve lending. And then commercial real estate exposure, especially for regional or mid-sized banks of 100 billion or more, they're the ones that have a lot of exposure, or even smaller banks. It's not the largest banks that have the largest real estate exposure, commercial real estate. It's the mid-sized banks and smaller banks. And then the high interest rate impact is really straining on the banking sector as well. So we do expect more bank failures to wrap up, by the end of the year. The stock market is looking like it's topping, another fundamental. It's greatly overvalued, and if it weren't for these 7 stocks carrying, which have been monikered the Magnificent Seven, then we would be flat or down so far this year. And unfortunately, any sort of weakness in the tech sector is really going to get the snowball rolling downhill, and that would be a strong dynamic for gold. Maybe initially gold comes down, but essentially it'll replace a lot of those positions that have been in the stock market. Debt is a huge one. National debt now almost at 35 trillion, adding almost $1 trillion a quarter. The debt to GDP is now 122%. The debt per citizen over $100,000 for each of us now, just in terms of that national debt. And then the credit card debt has exceeded 1.1 trillion. So Americans are going further into debt despite higher interest rates, and the higher interest rates kind of feed the cycle of debt. And that's resulting in hardship withdrawals from 401ks, really spiking to the highest levels in recent history, where people are having to pull money out just to get by. And that goes hand in hand with the inflationary issue. So the disinflation is the new term. You'll hear the Federal Reserve bragging about disinflation. All that means is inflation is still increasing. It's just slowing in its increase. That's not positive news. What's positive news is when we get deflation, where prices start to get cheaper. You're not seeing that yet, and we're not even close to it. The real inflation rate is still exceeding 8% if measured the way it used to be measured in the 80s, up until they changed it in the late 80s, early 90s. And now that's why we call it the CPI instead of the CPI. But interest rates depend on inflation. They're trying to keep the rates higher until inflation is in check. And then the numbers that they're using, again, are not trustworthy. So inflation's not going anywhere for the long term. We do believe that we're going to have higher rates for longer, as well as inflation for longer. And what that means is that you get this depletion of the purchasing power of the US dollar. And we're just dwindling to almost nothing. This goes back to 1913 with the inception of the Federal Reserve. And what gold does is just maintain its purchasing power. So unfortunately, the reason that gold is, at $2,300 an ounce is because of the fact that the US dollar has lost its purchasing power, and gold is maintaining its. It buys today what it bought in 1913 per ounce. Okay. So what are my recommendations? Here are the recommendations in closing. Buy the dips in metals this summer. So the summer tends to be the low for the year. We're in a bull market. I would buy the dips per those target entries that I gave you. Buy silver when the gold to silver ratio is over 80-1, and then let's discuss when it's under that point. Consider semi-numismatic or numismatic coins. What we do is we will play the premiums on collectible coins, or we will diversify into a non-bullion coin when it's a buyer's market. We will sell them when it's a seller's market. So we're going to advise you right now that we've seen the lowest premiums in our 52-year company history, and would strongly recommend that you be considering adding to your gold ounces in the semi-numismatic or numismatic category. A lot of those premiums are lower than just a newly minted bullion coin right now, and you can get an uncirculated 100-plus-year-old coin for the same price. So again, we would sell it when the premium spikes. Request an updated portfolio summary. I hope you can do that anytime. You just call me, Eric, Deanna, and we'd be happy to get you just an updated valuation on your holdings. Listen to Golden Rule Radio on YouTube. Miles and Rob and I love to get together and do a new recording every Wednesday for release on Thursday. So make sure you're listening to that, and you'll know where we stand and what we're seeing that week. Call us for bank ratings as well. With the bank instability, we can actually look into the stability of your banks. And then finally, walk through a portfolio update with me. I can even start by getting you a worksheet. That worksheet will get you started. And what we'll really get into is the investment triangle. It's just time to walk through, get pencil to paper. You don't even have to share dollar figures with me. We can speak in terms of percentages, but bringing balance between the three components of every investment portfolio, from growth to savings to insurance, being that tangible commodity that gets you out of paper, the precious metals. So it's time for us to get back on the same page and review it. So most importantly, just contact us. Contact me at any point, 866-211-8972, or email me, Tori@mcelvaney.com. I know you all have that, and I greatly appreciate the opportunity to continue serving you, as do Eric and Deanna. And as always, here's to a blessed summer and a great start to a third quarter and a strong finish to the year. Thank you so much.